Okay, good morning, everybody. I was just going to give it a few minutes for anybody who was struggling to get from the shower to their bedroom this morning, but hopefully the commute for some of you hasn't been too far. Appreciate that's probably just one upside of lockdown that we're currently on, but there is, as everybody keeps saying, a bit of light at the end of the tunnel now, and hopefully some glimmers from the budget that we had yesterday. So I suppose, first of all, welcome to our breakfast seminar. Thank you very much for taking the time to attend as well. There are three of us speaking today. Myself, for those who don't know me, my name's Matt Hodgson. I'm a partner with Claritas Tax, and I head our Manchester office. We've also got Cess Mamie, who is an associate partner and leads our transactions taxes team. And we've also got Sam Hart, another associate partner in the business, who leads our private client team. So those are the three of us today. A few quick housekeeping points, first of all. Your camera, I believe, and will be off, and also you're muted. But if your camera isn't off, and this is just a point of bandwidth so that the webinar doesn't crash, if you could turn your camera off, that'd be great. We can't see you anyway. We will be doing a Q&A at the end, but we'll be answering the Q&A questions at the end, but please use the Q&A button on the webinar as we go to ask any questions, and we'll be reviewing those as we go. This is being recorded and will be circulated later, so just so you all know that. And we'll be running a series of short polls at the end of each of our speaking sections, just to sort of gauge the general sentiment on some high-level tax issues. And yes, there'll also be a short survey at the end. So rather than disappearing off to whatever you've got next, it will literally take about 30 seconds just to do a quick survey on what you thought of the webinar today. So we'd be grateful if you could just hang around. So anyway, the budget, obviously that was the exciting news yesterday. And I was watching breakfast news this morning, and Rishi has somehow miraculously got up to Teesside and was being interviewed in front of a container ship. So that man is superhuman, in my opinion, how he's managed to sort of deliver a budget and then get up there and start answering difficult questions on it. I suppose at a high level, it was probably a bit less exciting than we all thought it would be. There has been a bit of a frenzy of activity, particularly M&A, in the last 3 to 4 months. And I'm sure those who are within the professional advisor arena on this webinar today have felt that as well, particularly in relation to CGT. But because it was less exciting, I think we're probably going to be able to wrap this up in 45 minutes instead of the full hour, which is probably welcome news for you all. It does feel, though, that despite some sort of major announcements, that the pain is going to come later from a tax point of view. And I think that Rishi did the right thing. I think it was a good budget from a personal perspective. Did the right thing, and the tax rises that are coming in further down the line to allow businesses to really get back on their feet and get going again and get the economy moving. So, politically, I think it was a good move. If we could just, and I'll be doing a bit of a Chris Whitty today, as will the other speakers, because I'm not in control of the slides. So could I ask for the next slide, please? Thank you. I do like to start with bigger picture. These statistics are released at the time of the budget every year, just to show, where the Treasury gets all their, where the revenues sit. And I suppose unsurprisingly, and it's the one that doesn't get talked about an awful lot, you can see their income tax and national insurance is an incredibly large amount of the revenue that the Exchequer receives. And probably the two main observations I've got on this particular point are, just bear with me a second. Just losing my notes here in a second. Oh, here we go. Yeah, so the CT rise, which is obviously the big one, which I'll come on to in a minute, will certainly have the biggest cumulative impact in terms of raising revenue between now and 2026, and that's estimated by the Treasury to be in the region of 48 billion, so a significant amount there. And whilst it wasn't a tax rise per se, I think we all could see that the freezing of the individual personal allowance and the higher rate threshold is a tax of sorts, and again over that same sort of timeline up to 2026 is expected to bring in a further 19.2 billion into the exchequer. So, you know, these are big figures, but I guess in the wider scheme of things, considering the amount of debt that has the country's had to take on in the last 12 months, which I think is in order of over 300 billion. It's a drop in the ocean. So I think going back to my original observation, I think there will be more pain to come, and we will see what happens, particularly in the autumn this year, once the economy starts to recover. So next slide again, please. Corporation tax. Just mentioned that's the biggest move, from 19 to 25%. It's not going to take place until April 2023. So we've all got a bit of breathing space and a bit of time to plan. He is protecting smaller companies and those that aren't necessarily going to return to profit as quickly as they'd like by ensuring that the current 19% rate stays for those with profits of less than 50%. And then it's basically a tapering increase up to 25% when profits, as you can see, get to $250,000. So kind of like the old marginal relief of sorts. Those thresholds, though, will be proportionately reduced for accounting periods that aren't 12 months, which I think is perfectly fair. And some of you may remember the terminology associated companies, whereby those thresholds, the 50,000 and the 250, will get whittled down depending on the number of associated companies. So if you're in a group, basically you need to take into account all the other group 51% group companies to understand where your threshold sits. And then the final point there about close investment holding companies, it's long-winded terminology, but basically where you've got a small, well, not typically a privately owned company with, as it says there, 5 or fewer shareholders, and depending on its investment activities, and I won't go into the detail there, then the 19% won't be available in those circumstances. So what does it mean for me? Could we move on, please, to the next slide? When I say me, I mean you, and obviously businesses out there, your clients. I suppose the first point there is the Chancellor is trying to be fair. I think the word fair was used and the word honest about sort of 25 times yesterday. It kind of is fair in some respects. So he's just focusing again on businesses that are profit making, have continued to make profit throughout the pandemic, and hopefully will continue to do so going forward. The main point coming out of the next 2 bullets is that it gives businesses time to prepare and actually get their house in order before these tax rises, the tax rise comes in. So things like budgeting and forecasting to take account of the increase, but also deferred tax provisions for those accountants and group tax managers and heads of tax out there, can start to look forward and plan and make sure that their accounting and losses and things like that are actually adequately reflected in their accounts. And then the final point, which reflects the final bullet on the prior slide, many of you will now probably be aware of the term family investment companies, which many of those are really these close investment holding companies where you've just got a few family members and the amounts are invested, for instance, via a wealth manager. And in those cases, again, the 19% rate on any profits arising probably won't be available, but there are technical points there around, for instance, if there's also rental property being charged at a commercial rate. So, but again, I won't go into the detail. So next slide again, please. Loss carrybacks. So again, I suppose it's a very circumstantial additional relief that's been introduced because you've got to have losses to carry back. But the overarching theme here is that the Chancellor is recognising that a lot of businesses will have made tax losses, probably unanticipated losses during the last 12 months. And he's now giving businesses the option of carrying those back further than was previously allowed. So at a very high level, businesses that do generate tax losses can offset them against profits of the current period, and then they have a choice as to whether to carry them back or carry them forward for offsetting future periods. These temporary rules that have been brought in will allow businesses, and you can see for the accounting periods on the slide to now go back up to 3 years, but the earliest year first. So so potentially quite generous, and we'll be expecting a lot of companies to be looking back, well, those who have made losses, and looking back and saying, actually, is there a way here to generate a refund? So if we can just move on to the next slide again, please. Sorry, a point that I didn't raise on the prior slide is they are capped, and there is going to be a cap of 2 million, which may not apply to most businesses. So it's much bigger groups, but the cap will be relevant to sort of bigger groups and that type of thing with those level of losses. I mentioned that, yeah, a corporation tax refund will be a real bonus for some companies if they can carry those back and offset further profits in those 2 prior periods. They can now extend to. There will be more complex sort of thought going on in relation to groups of companies, in relation to how such losses can be allocated around the group companies. And again, just on that housekeeping point about deferred tax, it will probably have an impact on, certainly if you carry them back, utilising deferred tax assets, and therefore some further work will need to be required on looking at deferred tax provisions and making sure that they are adequately reflecting the losses. So I think it's a good move, but again, I looked at the statistics on this, and I don't think it's expected to make a huge economic impact for businesses. So probably more just a kind of a vote winner as opposed to necessarily a real impact. So moving on to the next slide, please. R&D tax relief. I'm sure everybody, hopefully on this webinar's heard of R&D tax relief. It's big business in some respects these days. And it wasn't a measure as such that was announced in the budget. It was actually a consultation that was announced yesterday, a further consultation. But starting with the top bullet, what is coming in this year, which was a deferred introduction from a couple of years ago, actually, is a cap that's coming in from the 1st of April on how much a business can claim in relation to R&D and a tax credit. So businesses that make relatively small claims, so you can see they're below 20,000, will be protected. There is going to be no cap there, but anything above that will be capped, as you can see, at 3 times a company's income tax and national insurance liability. So that is actually quite a generous cap, but I won't steal my next slide and my comments from there. There will, however, be an exemption from the cap for businesses. As you can see, they're preparing to create, manage intellectual property, and it's an and test. So, and where less than 15% of the R&D expenditure is with other connected companies. So that means subcontractors. So cutting through that exemption, what it really means and what the revenue are trying to get at is if companies are truly generating their own intellectual property and conducting R&D activity that helps to grow and build that intellectual property, then they will be exempt from this cap. Whereas those that potentially subcontract a lot out, and therefore it's a bit of a grey area as to is it really their intellectual property or someone else's, will be subject to the cap. And then a further sort of, I guess, point of fairness around actually being able to demonstrate that you are managing your intellectual property is that it doesn't necessarily need to be patented as such. So they'll be widening the definition of intellectual property to know-how and trade secrets. And then the final point there is, again, just a fair one that was introduced and welcome. So where you've got an accounting period that goes over and straddles the 1st of April 21, the cap won't be immediately effective. So you won't have to sort of have part in one period and part capped in another period. It's only for accounting periods, as you can see, starting after that date. Next slide again, please. So as I mentioned, I don't believe that cap will affect most SMEs. I think it is still a generous cap, but certainly one that will need to be looked out for and further calculations done by your advisors who calculate your R&D claim. As I said, massive focus, and I think we're going to see that in that 3rd bullet point. There was a new consultation announced yesterday on really whether the R&D tax relief regime is fit for purpose. My view on that is it's because it's become a little bit Wild West out there in the world of R&D claims. The interpretation of what is qualifying R&D has probably gone a bit too wide, and there's, there have been some cases of abuse which have now been taken through the courts, and the revenue have been successful. So we as a business will certainly be feeding into this consultation process, and we'll see what the outcome of that is later on this year. And then the final point there is that there was a prior consultation quite recently about widening the definition of qualifying costs to include things like data and cloud computing costs. There were a lot of people and businesses that responded to that, but the revenue have decided to wrap their decision on that up into this latest consultation. So that's R&D. Next slide, please. And then the final point for me is free ports. I mentioned Rishi was up one of those this morning with his big high-vis jacket on, doing the kind of the statesman like. He looked like a prime minister, to be honest with you. Certainly what I saw. There are going to be 8 new free ports. And interestingly, some of the questions Rishi was getting was, how are these any different to the ones that were cancelled in 2012? So I thought that was a pretty good question, to be fair. I think the main point will be hopefully that these will actually happen, and the main benefit, as you can see there, is the fact that tax sites will be created within them. So there'll be incredibly generous tax reliefs, and I won't go through all those bullets one by one, but most of them, as you can see, relate to property, commercial property, and plants. So basically, stimulating investment into these areas. And the final bullet there on potentially complete relief from employer national insurance. So that could be huge in terms of generating employment opportunities. And what does it mean? Well, yeah, the obvious point is investment and expansion, but also, and I see this in the reverse often when businesses are looking to expand, say, into the US are very good on a state level at introducing sort of enterprise zone type initiatives and tax holidays. So I see this as a real stimulus as well for inbound investment into these areas by overseas entities. So that's me. Over to you, Seth.
Matt, do you want to do your poll now? Is that before we move?
Sorry, yeah, I knew I'd forget that. So yeah, we're about to do a poll. So over to you, please, on the poll. Here we go. So we'll give this 30 seconds or so.
I was just trying to vote then, Matt, and I realised I couldn't vote.
Yeah, I was too. Which one did you click, Seth?
I would say corporation tax was probably mine.
Yeah, me too. No surprises, corporation tax is the big one. I sometimes wonder whether that's why, because people feels it doesn't hit their own back pocket rather than anything else. But yeah, it's the one that Rishi went for. It'll be interesting to see what happens over the next couple of years on that. I've been around now 21 years doing this, and I was involved in quite a number of the entities that went offshore when tax rates were at 30%. I suppose the question in my mind is, will 23% start to generate and stimulate a little bit more of that activity? But only time will tell. So we'll close that poll now, and over to you, Seth.
Thank you, Matt. Morning, everybody. Thank you for attending this morning. Sam, will you please move on to the next slide? Thank you. So the first matter I will talk about is the impact of the furloughing scheme on EMI share schemes. So one of the conditions for qualifying an EMI share scheme is that a person must work, the working time requirement is that a person must work at least 25 hours per week, if less than 75% of one's working time. So that's concern into 2020 when the rules came in place that people who've got existing EMIs no longer can meet this condition. But the revenue thankfully brought in some legislation which provided exception to the furloughing exception to the working time requirements, whereby they said that if you're on furlough and you've got EMI share schemes, and that won't affect the furloughing, shouldn't affect your status of EMI share scheme. So that was a welcome addition to the rules. The next point, so tweaking those rules yesterday, what the government have also said is they want to extend that exception to new participants to EMI share schemes. So if you've got someone that you want to give EMI share schemes to, but because they're on furlough or they're on unpaid leave, or have had their working hours reduced so they can't meet the working time requirement, then the rules were tweaked to say that those people can also be offered EMI share schemes, as long as the impact is because of the COVID-19 situation, the furloughing on that. So that again is a very welcome relief. It's an important relief. It's one we see constantly, and it's a key one, which will be something I'll pick up on the next slide. So that's a great addition to the exceptions. Next slide, please, Sam. So this is what I just said. What does it mean for you? Is that existing participants are fine. It'll also allow for new EMI share options to be issued to new employees, which is great. So again, it's a welcome extension to the exception, as incentivizing key members of staff at this, certainly in the current climate, is critical, especially if you want those key members to be around to drive the post-COVID recovery, which is very important. And even more important is the fact that actually cash is limited, and cash is king, and so certainly a lot of people are not getting pay rises or on reduced hours. So if there's any other way to incentivize and retain those key people, then this is obviously very important for that process. So let's see what the rules say when the law is published in the finance bill. But again, I think it's a great idea, and the fact that actually are helping businesses in other ways is a welcome relief. The next slide, please, Sam. So the next point is the repeal of the interest and royalties directives, and this is directly because of the impact of leaving the European Union. So under the current rules, there's an exemption from withholding tax on intergroup payments of interest and royalty payments between UK and EU associated companies. And then from the underlying legislation, domestic legislation, which gave effect to this directive, is still around. So technically, you can still make those payments without withholding tax. So the Treasury is changing those rules from the 1st of June. So that will no longer apply from the 1st of June, which means from the 1st of June, withholding taxes will have to be withheld on any interest payments and any royalty payments made to EU companies, which means that you'd have to now resort to looking at the double tax treaties between those countries to see if you can pay those payments either at a reduced rate or or you can pay them at the completely 100% rate, 100% of that payment, as opposed to being reduced by the withholding tax in the UK. So the access to double treaty rates, I've got experience of this. It's painful, because in order to get access to those rates in the double tax treaties, you have to get authority from HMRC, and that can be time consuming, it can be painful, and it can take a long time, longer than you think it would take. So the impact on yourselves would be this cash flow impact on the recipient. So it's very worthwhile to review your circumstances now, if that's something that you make on a regular basis, because it will take, and you can imagine the influx of applications to HMRC with the removal of this rule. So there's a bit of time yet to get there, but certainly something to look at and review your circumstances going forward. Next slide, please, Sam. So Mark, the next one is to talk about the super duper deduction that Rishi talked about, and is it really that super? I'll leave you to make your own conclusions as I finish my slides. So the new rules apply, the super deduction and the new finance first year allowances for investment into capital assets. So what the government are trying to do, certainly what Rishi said yesterday, he wants companies who have either generated a lot of cash and sat on that cash through the pandemic, or companies just with a lot of cash on the balance sheet, to start using that and investing that money in capital assets. So between the 1st of April and the 31st of March 2023, the companies investing in new qualifying plant and machinery will benefit from new first year allowances. So the super deduction is 130% allowance, which will be available for any costs incurred on plant and machinery, such as, as you say, machinery, fixture and fittings, computers, etc., which qualify for capital allowances in the main pool. The main pool is where you get a 80% annual allowance, annual withholding, writing down allowance, sorry, each year. And then you get a 50% first year allowance for any assets which qualify for the special rate pool, which is a 6% pool. So there's only a limited amount of assets that fit in that pool, such, internal fixtures within buildings. And then the last point he made was that the annual investment allowance of £1 million will be extended for another year, and that will apply from the 1st of January this year until the 31st of December of this year. So the impact of that, it might actually make the super deduction might actually make this irrelevant, except for the special rate pool. So it's something to watch out for. But now we've got 3 different types essentially of upfront allowances. You've got the super deduction, you got the new 50% first year allowance on special rate pools, and you've got this annual investment allowance, which is all great, but you've got to spend the money to get these allowances in the first place. Next slide, please, Sam. So what does it mean for you? I suppose if you've got the cash and you want to spend the money on qualifying capital allowances, then the enhanced relief should lead to lower corporation tax bills. The one thing that's not clear, which is alluded to in my previous slide, is how AIA, the super deduction, and the 50% first year allowance, how they all work together. It's not currently clear from the press that's been put out by HMRC and the Treasury, but well, I'm sure when the legislation is published, it should become clearer. So by way of example, what I mean is if you spend £1 million on qualifying capital expenditure, which one would you use first? Ideally, you'd want to use a super deduction asset to qualify for relief in the main pool, so you get 130% relief there straight away, followed by the annual investment allowance on assets qualifying for a special rate pool, and then the 50% first year allowance on anything remaining in that pool. So whether this is allowed and will become clear in the finance bill, but that ideally would be the best scenario in that situation. So looking at the super deduction, just by a very quick example, as if you were to buy a new machine which qualified for capital allowances under the main pool for say £1 million, you now deduct £1.3 million from your taxable profits in the year of purchase, which will give you a tax saving of about £247. So you should also be mindful of the time of the expenditure, because if it's incurred in periods outside, or sorry, that straddle the period set out in my previous slide, then you have to portion the reliefs between pre and post that period when the reliefs apply. So you're just going to be mindful of when you're spending the money. So if you've got plans to spend on capital assets for your business, for your manufacture, etc., whatever you want to spend on capital investment, then just be mindful of when you spend that, and hopefully you can utilize these new super duper rules and reliefs. So one of the other things that's come in relation to the super deduction is obviously it's a very good relief to have, but there's also brought in new rules on how you deal with the disposal of such assets. So I think there will be a requirement to for those sort of super assets subject to the super deduction to have a separate pool, because there will be subject to different disposal rules. So that's another admin requirement when you're doing your tax returns, and something to be monitor when you're acquiring such assets which are subject to the 130% super deduction. So whether that actually leads to a greater amount of capital investments for corporations, I don't know, because cash, in my view, cash is king. Whether you want to spend that much money on capital assets at the moment, if you've got the cash, then fair enough. But if you haven't, I suspect you probably wouldn't want to spend that much money. But who knows? It might create a little bit of activity for the tax person, the tax man, certainly. Sorry, the one thing I didn't mention in my EMI, which I'll talk about now, just come to me, is there is also a consultation on EMI share schemes, a general consultation, a bit like the R&D one, about whether the current EMI share scheme is fit for purpose. So they're doing a general review of that as a consultation that's going to kick off on that matter. I think my view is it's a very good relief. I think it does meet most requirements. I'm sure there's a bit of tinkering required around the edges, but my view it's a good set of rules, and generally very it is generous in terms of what it could apply to. That's the last thing I was going to talk about. And before I go, there's going to be another poll on this super deduction, which Sam has put up now. So I'll give you 20-30 seconds on that.
I feel like we ought to be playing some hold music at this point.
It feels like it, doesn't it? So yeah, it will not affect my capital expenditure purchasing decisions. Purchasing decisions is a result which is I'm not surprised about. So I think it's probably slightly misguided that the chance I think it's going to create that much activity, but it's no surprise that that is the view of most people. Well, thank you everybody for listening to me. I will now pass on to my colleague Sam Hart.
Hello and good morning. Obviously, last but not least, for those who don't know me, I'm Sam and I'm head of the private client department here at Claritas Tax. And if Sam could put on my slide, please. My first point is that actually there's very little to discuss on private client taxes. I feel a little bit like I've turned up at the church with a big dress on and only to be told I'm the bridesmaid and not the bride. I was anticipating loads to talk about, and actually there's not very much, but I'll go through it anyway. I thought I'd mention the SDLT extension, worst kept secret that we've had. Has been extended to the 30th of June, which will be a relief to all those people who are currently stuck in a chain and unable to get their searches through and things by the end of March deadline. That extension applies to properties up to 500,000 and is actually worth about £15,000 in SDLT. But after that, we're going to have to stop having a cliff edge. The 0% band is going to be increased to 250, up from 125,000 until 30th of September, which saves you a far less generous £2,500. The SDLT extension has really stimulated the housing market, but it's also stimulated prices. Evidence has been showing that actually part of the effect of this is raising prices, which is good news for vendors, perhaps not so good news for buyers. Another unintended outcome of it appears to be that some landlords have been using it to increase their property portfolios, which perhaps wasn't the intention, but if the point was to stimulate the housing market, it's certainly done that. As Matt mentioned, the income tax rates and allowances have been frozen until April 2026. So from next year, the personal allowance will be 12,570, and you'll start paying high rate tax at 50,270, which is barely higher than it is now. Also, the capital gains tax annual allowance amount has been frozen, not halved as had been suggested, but frozen at the current level of 12,300. Interestingly, the Chancellor also mentioned that the IHT nil rate band and residence nil rate band had been frozen. It's interesting because this doesn't change annually anyway, and it's been the same since 6th of April 2009. So it's not like we were all expecting it to go up in any case. But that's another good example of what Matt was talking about, how it's kind of a stealth tax by if you leave the levels as they are, then as income and assets increase in value, that you're getting more tax. When the IHT nil rate band of 325,000 was introduced in 2009, if you index that up using a housing index, a house from 2009 would now be worth almost £500,000. So just by doing nothing, the Chancellor's getting more tax. I mean, clearly the effect is more strongly felt in London, where the same house would be worth over 650,000 now. So essentially doubled in value, but you're only getting half of that value relieved under the nil rate band. The residence nil rate band was only introduced a couple of years ago, so it's not so out of date in terms of what the value of it is, but also the level at which the tapering kicks in of 2 million has been frozen. So again, as people's estates increase in value over time, more and more of them are going to become unentitled to the residence nil rate band, which can pass on an extra amount of value if you're leaving your home to family line members. The other thing he talked about freezing was the pension lifetime allowance. This is the total size of your pension pot, and if your pension pot is over that size at the crystallisation points, then you'll have to pay a tax charge. That limit is £1,073,100. And that's going to say the same for the next 5 years, the same April 2026 date. But most people, the whole point of having a pension fund is that it increases in value. And if that were to grow at 5% a year over the next 5 years, then by April 2026, that would be worth £1.3 million. So, again, it's another sneaky way of getting tax in. But what I think really was the biggest announcement in the budget was the non-announcement of any changes to capital gains tax. So much speculation had taken place about it, and we certainly had seen so much increased activity in deals with people trying to get things over the line before the 3rd of March. Other things that weren't included that may have been talked about was pension high rate tax relief removal. Clearly, at the moment, to the extent that you can pay pension contributions up to your annual allowance of £40,000, you can get high rate relief if you're a high rate taxpayer or additional rate relief. And there was some talk that that would be withdrawn because, again, it's people who can afford to make large pension contributions getting an extra tax deduction. Having said that, last year he increased the limits upon which your annual allowance gets reduced because you've got high income to account for the junior doctor. So it would perhaps have been a little bit odd to do that last year and then scrap it all together this year. There wasn't anything mentioned about a wealth tax. That's another thing that's been a hot topic recently. You may have seen the Wealth Tax Commission report that came out in December that actually recommended a one-off wealth tax rather than an annual wealth tax. And it was levying a 5% one-off tax, always 5%, worked out at 1% a year over 5 years. Now, we can't rule out a wealth tax. I think, as Matt said in the beginning, the tax measures announced today aren't going to fill the hole in the coffers. But also, the Chancellor did talk about making sure those who could pay did pay. So it's an interesting argument whether it is going to be on the cards in future. And just the very fact that we're even discussing a Conservative Chancellor introducing a wealth tax shows how much the goalposts have moved. He did liken his budget yesterday to being one after wartime, and that is also the reasoning behind a wealth tax. There was also a consultation result published on the 1st of March, actually, by Treasury Select Committee, which was called Tax After Coronavirus, and it was looking at what that committee was recommending took place in terms of taxes. As far as a wealth tax is concerned, they said that the administration of an annual wealth tax would be extremely challenging, and they noted that other countries had abolished annual wealth taxes after introducing them. I mean, for example, in 1990, there were 12 OECD countries that had a wealth tax, and now there are only 3. So overall, the Treasury Select Committee did not recommend an annual wealth tax, but they did say that there was more support for a one-off wealth tax and it could raise significant revenue. And that was really the point of the Wealth Tax Commission report, was that by levying this wealth tax, which was on wealth over £500,000 per person, which is probably ridiculously low level, but perhaps if you start saying it at 500,000, if you bring it in at 2 million, people won't complain too much. But if you did bring in their wealth tax on wealth over 500,000, it would be the equivalent of putting 9 pence on the basic rate of income tax, which is a massive amount of tax. But the Treasury Select Committee did say that they had significant reservations about a one-off wealth tax because they felt that once imposed, people would feel there would be no reason why it couldn't be imposed again. And that really is the point, that a one-off wealth tax only works if it really is one-off. So the last point is coming back to CGT, which I'm quite happy it hasn't changed, because it's one of the few taxes that they haven't changed all the legislative references since when I learned them all those years ago. So I'm quite happy. That said, I think it's only a stay of execution. The OTS report on the changes to capital gains tax, in answer to the Chancellor's specific request for one, recommended various reforms. The headline was, of course, align CGT with income tax rates, which isn't strictly true, because the report also said that you ought to make some allowance for inflation or increase of the value of assets over time, much like we used to have with taper relief before they scrapped that. Also business asset disposal relief, which is the new name for entrepreneurs relief. They fiddled with it last year. There were fears it would be scrapped altogether. And part of the reason for this is because the government have been changing their focus really with reliefs. And rather than having reliefs as incentives, they want reliefs, they want reliefs to be incentives rather than being a reward. And entrepreneurs relief was often seen by entrepreneurs and the wider community as being a reward for entrepreneurs risking their money and growing their business rather than an incentive. And the government's argument was that actually encouraging people to become entrepreneurs? And to which the answer is probably no, because if you're that way inclined, if you're going to set up and run a successful business, you're going to do it whether there's entrepreneurs relief or not. So that's why the entrepreneurs relief is kind of falling out of favour. But been no changes so far. We'll have to wait and see. Again, the Treasury Select Committee said that they believe there is a compelling case for the reform of both CGT and IHT. So I really do think it's watch this space, and perhaps I'll get my day in the sun at the next budget. So just to finish my section, I wanted to do a quick poll talking about the capital gains tax, because that's the most interesting thing that wasn't in the budget. So yeah, my poll is, did you or did anybody you know do something to try and crystallise that tax at today's rates? Oh, there we go. So yeah, and that's quite compelling, isn't it? 62% of people either did or knew somebody who took action. It just shows how worried about it people were. From our point of view, from my personal point of view, as a private client practitioner, I've had so many more queries about going offshore, which used to be a thing, 10, 15 years ago. And then it wasn't. And then now, because people are afraid of the raise in rates, people are thinking about, more dramatic things they can do to save their tax. So yeah, that's really interesting. And thank you for answering the poll. So we're going to move on now to some questions and answers. And we've had a couple come in, so I'll perhaps start asking them, and Cess and Matt can jump in to answer them as and when we go. So the first one we had was about the super deduction. And the question is, will the allowance be based on the invoice date, or will it be based on capitalisation date?
So the answer to that question, Chris, is when their costs are, you bring them in when their costs are incurred in the accounting period, but more importantly, and the new rules do say this, there's loads of anti-avoidance rules around this, because you can imagine people do all sorts of things to kind of bring forward or bring into these, bring the cost into these rules. So there's got to be a unconditional contract for the purchase of that asset. So that's a key, one of the key ones really. There's no, that you do own the asset, there's unconditional contract in place. And as long as you've got those two elements, then yeah, you can bring it into your accounting periods and into your tax returns. I hope that answers your question.
Okay, we've got another question on a similar theme, which is said that you weren't sure how the interaction will happen between the AIA and the new super deduction. When are we going to know this information? And I imagine
I think as per the slides, I said we'll know more when on the publication of the finance bill. So that's when that comes through, we'll know if there's any interaction with the existing rules, or and how these new rules work with those existing rules, as well as the AIA. So I'm sure we'll put out a press release once those rules become clearer, because like all of us, we'll have to do corporation tax returns every year, and we want to know what's the best way to acquire these assets and to manage our tax rates and tax bills.
Okay.
Go on, Sam.
No, I was going to ask a next question. Were you going to carry on with that one?
No.
Okay, sorry. And we had another question, which I think Matt mostly answered earlier, but we'll just perhaps refresh over it. It was whether family investment companies with property portfolios will pay the higher rate of CGT, presumably if their profits are at the lower level.
Yeah, so it's a good question. I think there is a nuance there in terms of what is termed a closed investment holding company, which is the terminology. And it's really getting at very passive investments. So, but where, for instance, it's property with a commercial an arm's length rate of rent of return, then there's probably a technical point there that it isn't a close investment holding company, and therefore potentially wouldn't be subject to the higher rate of corporation tax when that comes in. But I guess all I'd say is any family investment companies will need to be looked at on a case-by-case basis to understand the underlying investments in that business, because for those of us involved in family investment companies, they often have a range of investments, be it making loans, funds invested by wealth managers and platforms, rental properties, so on and so forth. So unfortunately, as ever with tax, there isn't a clear-cut answer. But I think if it was a pure business just renting out properties on an arm's length basis on a commercial rent, it should be okay and should be subject to the 19% rate. Obviously, if its profits are below that, the threshold as well. So hopefully that answers that one.
Okay. We've got one other question to do with corporation tax, and it says, will the corporation tax position change where a holding company only receives dividends from its wholly owned subsidiary?
Well, I suppose there's a couple of answers to that. There technically wouldn't be. If the question is around will that holding company get taxed, then no, because it's just receiving a dividend from another UK company. But if we're talking about the reduction of the thresholds through having an associated company, then yes, there would be an impact through having two entities. Unless, Seth, have you got anything to add to that? Unless I'm missing the point there.
No, I think that's right. I think that's what I don't think I've got anything else to add to that, Matt, but what you said.
Okay, fine.
Okay, and I think we've just got one more question, unless anybody else would like to ask another one, and that's, what's the likelihood of a wealth tax, and can I do anything to avoid it? So I'll answer that one. I'll just check my crystal ball. Unfortunately, we don't know if a wealth tax will come in, but the likelihood is if it does come in, it will have almost immediate effect. That was one point specifically raised in the Wealth Tax Commission report, was that if you're going to do it, it needs to be effective on the day or the day after announcement, because otherwise people will just transfer assets around to try and avoid it. So unfortunately, it's another, we have to wait and see what happens.
Great. Thanks, Sam. Okay, if we could just move on to the next slide quickly. So any further questions that may arise to you once this session's over, please just send them through to the info at or your usual contact at Claritas if you have one. And then next slide and final slide, please. Just a big thank you again. So appreciate it's an early start for some of you, and for those homeschooling, never easy. But for those who are, a bit of light at the end of the tunnel on Monday when all the schools go back. I, for one, will be delighted about that, even though I do love my daughter to bits. She needs a bit of structure that I can't give her. So once again, thanks for your attendance. Hopefully there were some useful things within there, and enjoy the rest of your week. Thank you very much.
Thanks. Bye.
Thank you.